Thank you very much for being here and a very good morning to all of you. After 25 years in this business, I have to speak without a podium. So let me do my best. So when I was starting work in 1991 in SBI Mutual Fund, in the morning IC committee meetings, one gentleman remarked that I say, why do these markets fluctuate? Why can't the stock exchanges put together a committee and fix a fair value for the stocks? So it was a very naive question and we laughed it off. But actually it was raising a very fundamental, a very basic issue. That why aren't markets perfect? That was the key issue. And we all know from experience, and I have observed it any number of times, that markets are anything but perfect, not just over short periods, but actually over extended periods, markets can be grossly imperfect and they can get things quite wrong. And how the majority opinion can go wrong over extended periods is something which raises a very basic, very fundamental issue. And if you look at last 25 odd years, since 1991, I mean that's my experience, we have seen three very big, very major cycles. And each of these cycles created immense amount of wealth if you were an early investor. And the same cycle destroyed huge amounts of wealth for a very large number of people if you were a late participant in the same cycle. So the key issue is how can the majority investors, experts, analysts, fund managers, media generally get things so wrong. So I think the answers lie in investor behavior, the way our nature. So we are all human beings after all, and we have often read about emotions like greed and fear, that stock markets are driven by emotions of greed and fear in the short to medium term. But I think what is happening here is that these emotions are not constant in us and they change over time. So let me just describe to you few cycles that I have observed, and I think you will appreciate better what I am trying to explain. Either due to business reasons of the way a sector is evolving, or due to the changes in the environment, the macroeconomic factors as they are changing, a sector starts doing well. And very few people observe it because it is either a new sector or it has not been doing well for many years in the past. So very few people observe it. Some very early, lucky or well-researched investors participate in it. And as that sector keeps on growing, as the conditions in the environment continue to be favorable, those stocks do well because earnings do influence stock prices very significantly, we all know that. So that sector creates a little wealth, more people observe it. The confidence of the earlier investors goes up a little bit and they invest a little more money. Initially people take money out of a bank FD or cash and they invest. Now this process continues for few years. More and more people start observing that this sector is creating wealth, your past experience is good. And over time, this process takes 4, 6, 8 years, that is what I have observed. After this has continued for 6 to 8 years, virtually everyone or a vast majority of investors are not just exposed to this sector or this theme, but they are grossly overexposed. Initially they were deploying cash, maybe 1%, 2%, and in the end, they start selling other stocks. And this is how you can see, initially there was a bit of fear that this is a new sector. So do I participate in it? You deploy a small amount of capital. You make some money, your fear reduces, your greed comes in. And in stages, you become more and more confident about that sector and the theme because we are all conditioned by our experiences of the past and more so the recent past, that is human nature. So as greed keeps on increasing, the environment is supportive, the news flow is supportive, the media is supportive, analysts are supportive, fear keeps on reducing. And in the end what happens is that the vast majority of people like us are overexposed to a sector or a theme. And guess what happens when almost everyone is overexposed to the same stocks, same sector, same theme? It will naturally become overvalued. And the last stage is, since your greed is so powerful and fear is not there, the confidence is so high, now you have forgotten the discipline of diversification in equities. And our portfolios become heavily skewed towards just that sector or theme. So since we have sold everything else has become extremely cheap. And this is what creates an excess in the marketplace. This is what creates what we call normally as a bubble in the marketplace. And then how does this bubble end? It has, if you go by past experience, I think there are two ways this bubble has ended. Either the earnings start disappointing, that a stock is trading at 400 PE multiple and you were expecting 80% growth, but the growth is 60%. And it repeats quarter after quarter, the growth rates are slowing down. So that is one way how an excess can correct itself in the marketplace. And along with this, something else also happens. We can see that something when it is very expensive, there are many people who are smart. They could be entrepreneurs, they could be large shareholders, they could be mutual funds, they could be the owners of these companies. So these companies will start issuing new equity, they will start issuing new shares, and the supply of stock in that space increases dramatically. Initially it gets absorbed as investors sense opportunity, but the supply just keeps on increasing, and this is what eventually leads to a correction. And meanwhile, since everything else is very cheap, some long-term investors sense an opportunity there, and that is how a new cycle starts. So this is a very simple slide. Maybe some of you have seen it, something similar earlier, but this describes what I have experienced in the markets over the last 25 years. This gives you, in a nutshell, the returns of different sectors in three different phases of Indian stock markets. 1995 to 2000 was the IT boom, we all know that. In this period, if you observe on the table below, you will see that IT stocks went up almost 100 odd times, 96 to 97 times. If you look at other sectors in the same period, automobile stocks fell by 30 to 70%. So you can see in IT, 1 rupee became 100 on an average, and in automobiles, it became on an average 50 paisa. So the gap in returns was 200 times. And when you go back and see, IT was a new business, it was evolving, the market was very large, Indian businesses were very competitive, and they delivered growth, and the sector which was initially trading at 15-20 PE multiple eventually peaked at between 300 to 500 PE multiples. When IT was the most popular, when everyone was heavily exposed, if you looked at anything else, since those stocks had fallen sharply, they were trading at 1, 2, 3 PE multiples, below book values at 5, 10, 15% dividend yields. And that is what set the stage for the next cycle. If you look at the second cycle, which coincided with a sharp upward movement in macroeconomic conditions in India, with low interest rates and with a upward move in commodity prices also, because China was emerging as a very major and a fast growing economy. You can see in this cycle, the best performing sector was capital goods. These stocks went up on an average 30 times. So I have experienced BHEL go from 100 rupees all the way to 3000 rupees. And you can see automobile companies, retail banks, corporate banks, refineries, all these sectors did extremely well. IT, FMCG, pharma did not do as well in this period. By Jain 2008, this process had continued. What began in 2001, the same cycle continued. Investors continued to gain confidence in commodities, in capex. And by 2008, we were in a situation where a company like Jaiprakash Industries, market capitalization was same as Hindustan Lever. Now you can look at that this is clearly, it was giving you a clear hint that something is wrong, but the confidence in infra stocks was so high, and since consumer stocks had not done well, people thought these are useless stocks. and that is what created this aberration. If you again go back and see in 2007-8, the supply of new shoes, new stocks in that space infra was very high, just like it was in 2000 in the IT space. And that is where that cycle ended. We all know what has happened to the infra cycle in last few years. And that set the base actually for the third cycle, because the consumer stocks, pharma stocks had not done well, though fundamentally they were very good businesses. They were simply out of investor favor. So in around 2005, 6, 7, you could buy FMCG companies in low double digit PE multiples, and today they trade at 40, 60, 80 times. So you can see how cheap they were way back then. And if you look at the last cycle, it has been completely different yet again. In this, the best performing sectors are in pharmaceutical and FMCG. Now, the macroeconomic conditions also play an important role in this whole exercise. If you look at the conditions of macroeconomy in 2001 to 7, we had stable currency for 10 years. Rupee was stable. We had by and large low interest rates. We had low inflation, which is not very favorable to exporters like pharmaceuticals, is not very supportive of faster growth for FMCG companies because inflation is low. And it is very supportive of capital expenditure because interest rates are low. If you look at last 7-8 years, it has been very different. Inflation was very high in double digits. Currency has fallen from 40 rupees to 70 rupees broadly. Interest rates have been extremely high. Therefore, the growth drivers of earnings shifted to companies which benefited from high inflation and from low currency, which was pharmaceuticals and FMCG. And it hurt companies which are hurt from higher interest rates, like in the capex space. Now, where are we today? I think we are on the stage of yet one other change in the cycle in equity markets. If you look at the macroeconomic conditions today, interest rates have fallen. For the first time in many, many years, probably first time ever, FDI in India, foreign direct investment, is 4 times that of current account deficit. And that is why despite record selling by foreigners in the last quarter of $10 billion between equities and debt, the currency is still doing quite well. So I think we are looking at an environment where currency should be stable, interest rates should remain low, and inflation should remain low. Low interest rates benefit companies immensely. Mr. Buffett has said that interest rates act like gravity on stock prices. So lower interest rates will drive profit growth up, and it will drive up the fair PE multiples. But the drivers of profit growth are shifting because now companies which benefit from lower interest rates, stable currencies, revival in capex will grow faster. And this is what I think is, this is the stage where we are. But if you look at the majority opinion, it has been consensus can be right sometimes, but it can also be massively wrong. And if you go back and see in late 99, 2007 and today, around the peak of the earlier cycles, these were the most popular investments of those times. So this is what I have learned from experience. This is not there in any textbook, and I thought of sharing this with you, and I hope you find it useful. Thank you. Any questions here?
How do you, what goes on into your projections when you're making a call on the markets, or you're making a call on stocks, sectors, economies? What goes on into, what is the basis on which you make all these projections? Because it cannot be merely linear. You cannot extrapolate from the past.
So I think the question is that what goes into stock selection?
No, the question is when you're making any projections, any assumptions about the way the economy will grow, the way the outlook of a certain sector, and then performance of individual companies. On what basis do you do that?
So I think it comes from a understanding of what are the key drivers of a business. So, for example, if you look at where are we today, we know that inflation in India is quite low. We know that borrowing costs are falling very sharply. So it is quite simple. If you are patient, if you are willing to wait for 2-3 years, you will see the benefit of the lower interest rates get passed on to the companies. If companies are cash rich, their other income will fall. If inflation is 4%, companies which have immense pricing power, which take price increases in line with inflation, their nominal growth rates will suffer and they will report growth equal to volume growth only. If currency is stable, despite FII selling, if FDI is 4 times CAD in India for the first time, it is telling you that currency may not depreciate, at least meaningfully. So businesses which have benefited in the past from fast depreciation in currency and leading to high profit growth, those assumptions could possibly be wrong. So I think the key in this is to understand what drives your business, is the business sustainable, and to take a view on those key drivers in the business. And I think this, as the economy is cyclical, as the current account deficit, interest rates, inflation are going through cycles, so are the businesses which benefit or which get hurt from these. And I think we can also keep at the back of our minds what are the government's priorities. So we have seen that 2 different sets of governments have very different priorities. So I think that will again help, because the policy environment again has a material impact on the businesses. One question is, are cycles in equity linked with cycles of life or evolution of human life? So this I don't think I would like to attempt. But I think maybe someone else, or you need to get a speaker with different skill sets. Will SIP inflows be so huge, make FMs lazy? Will SIP inflow allow the FM to average endlessly? Will FMs become NAV protecting? So I think if the issue is that if inflows are so heavy, will you stop working? I don't think so, because we are all living in a relative world and we just don't want to do good. We want to do better than the other person. So that is human nature. That is what keeps us both motivated and dissatisfied at the same time. So I don't think we should expect that to happen. The second question was to average endlessly. If the issue is that if you keep on buying your prices, does it support prices? I don't think that happens. You can buy all the stock in the world. Some people have tried this. It does not work, because the day results come, what happens next day? I may own 99% of the stock, but when results come, if they are below expectations, the stock can open 20% gap down. There may be no buyers at all. So the stock price is always determined by the marginal buyer or the marginal seller. So how much stock you or I own, I don't think it works in the long term. So I don't think that should be a concern at all.
I'll take one final question. How would the developments in the US, which is the new president, and possible elections of nationalist leaders in Europe affect our markets?
So I think first the US has to figure it out. So what it means. But in India, I think we are in a very good situation. The macroeconomy, the Indian economy has very weak linkages with what happens outside India. And it has been proved right time and again. Even when Lehman crisis took place, the economy did reasonably well. Stock markets have short-term correlation with outside markets, but not the Indian economy per se. We all know the long-term growth drivers of India: demographics, joint families breaking up, low penetration, and many things like that. I think at this point of time, we are in a particularly strong position, because as I mentioned, it has not been talked about much, but the foreign direct investment of India, FDI, as percentage of GDP, has gone up from 1% 4 years back to 2% of GDP. Our current account deficit, which was 5% of GDP 4 or 5 years back, is down to under 0.5%. So what this means is your FDI is 4 to 5 times that of current account deficit. And this makes us very, very secure that even if FII monies don't come, even if US interest rates were to rise higher, I think in this type of an environment, this country, this economy is extremely well placed. And I also feel that the growth opportunity that India presents to the world is widely understood by everyone. India is the world's fastest growing economy. It should also be the world's 5th, 6th or 7th largest economy in the next 3-4 years. And capital naturally moves to opportunities where there is growth. So I think that both the FII flows on the equity side especially and on the FDI side, we should continue to get higher inflows over time. The debt inflows, I think opinion could be divided because the gap between US rates and Indian rates is quite reasonable now. And should US rates keep on rising, I think the debt inflows could be at risk. But we are extremely secure, as I mentioned, because today we have 1.5% surplus balance of payments, which is about $30 billion a year, which is quite sizable. Thank you.